Things Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain. Thanks for joining us today. We've got a great show in store for you. We're going to talk about the markets and some year-end tax issues. I had hoped to devote this show to the new tax law that will hopefully be passed this year, or what to look forward to in 2011. Unfortunately, I'm hesitant to talk about that just yet because nothing is actually signed. There are some interesting proposals on the table in Congress. Of course, the Senate had a straw man vote on the current proposals. So the current proposals are to maintain the 2010 income tax rates for 2011 at all levels, as well as increase the estate tax exemption up to $5 million. So just a little thing. Maybe next week we'll have some closure on this issue, and that will give us an entire week to do some year-end tax planning. Nothing like waiting till the last minute. I don't usually like to get into too much politics on the show. We try to stick to finance, but I have to mention one thing that I heard, I think it was last week or the week before, was our Speaker of the House talking about how unemployment is a stimulus to the economy, and I just have to take a little bit of issue to that if that was the case, then why not just have 50% unemployment and just give people unemployment checks? Well, the reality, and this ties into what we're going to get into in the show later, but the reality is to have a growing and thriving economy that you really need people employed in the marketplace making things, goods and services that other people want or desire. Anything short of that is at best a temporary type stimulus, and we should not lull ourselves into thinking that transfer payments from the government are going to keep this economy propped up. We have to get back to making goods and services that people want and desire. But before we get into that, for those of you maybe tuning in the first time, we always encourage people to send us their comments or questions, topics they'd like to see addressed on the show. In fact, today we're going to talk a little bit about the Roth conversion, which is in response to some of our viewers and listeners' questions. So our phone number is 633-0107. Of course, that's area code 252-633-0107. The email is allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. Also, go on over to our website, www.dlblain.com, dlblain.com. There you'll find information about myself, my firm, as well as archive copies of the shows if you missed them. So we'd love to hear from you. Before we get into a topic on the Roth, let's talk a little bit. Last month in November, the U.S. Aggregate Bond Index suffered its biggest decline of the year and the most since February of 2009. It was a dismal month for the bond market, and this is a lot of concern to some of the conservative investors out there that invest in bonds. As you may or may not know, as interest rates or yields go up, the price of bonds go down. And so if we start to enter into an inflationary environment, the price of bonds will go down. Now, of course, if you're holding to maturity, you will still collect your coupons and get paid at maturity. There was also a lot of concern about the muni bond market, especially big states like California and Illinois possibly being bankrupt. So we don't think the bond bubble is quite ready to burst, but there are some cracks showing, and we would encourage people to take a look at their fixed income holdings, understand what they own and the risks involved. Although fixed income is less risky in general than the stock market, there are still some significant risks, and you should definitely be aware of those and taking a look at them. We'll get into periodically we like to give what's called a sentiment update, the optimism, pessimism of the market. once again, for people that may be tuning in for the first time, our investment philosophy is what we would call a fusion approach, meaning that we take a top-down perspective. We look at the macro picture, what's happening globally, GDP growth and, what countries are emerging and the, demand for commodities and supply and issues like that. We also look at fundamental factors such as earnings and what industries are on the rise, what industries are declining. We also believe, and that's where a lot of sort of fundamental investors stop, is they just look at the financial data. Well, we believe that there's two other big things that you should look at. Number one is what we call the trend, is look at how things are actually happening, what is actually happening, where the macro view and some fundamentals are more an estimation of what we think should be happening. If there's good GDP growth, we would hope that the markets would be going up. Well, by looking at the trend of the market, we can tell, is this actually happening or not? Because the markets do not always follow what the economics say that they should. And then the last component of this fusion approach we take is what we call sentiment or investor psychology. And in the short to intermediate term, actually, we believe that this is the most important factor of all, that it's been shown statistically that if you have a good poll and you're looking at the optimism or pessimism of both professional investors as well as the general retail investing public, consumer confidence, things like this point to a optimism or pessimism on the markets. And in the short to intermediate term, that's what drives the market. So we saw that we had a relative bout of over-optimism, that some of the data I look at, almost 70% of the people polled were very optimistic about the markets in October. And so what generally happens when people are too optimistic, the market goes down. And that's exactly what happened. November, especially in Europe and places, was a very poor month. And so we see this week the relative optimism decline. Well, now it's starting to creep back up. We've always said to expect a year-end rally. We still expect that in December, the last part of December, we expect a year-end rally on into 2011. We'd like to see the optimism not quite be so high. We'd like to see a little more pessimism built in the market for a better rally into the year-end. I don't think we're going to see that, so we would expect a very modest rally going into year-end, but we would not expect a tremendous amount of weakness going into year-end. So if you're looking to late in the year to do some tax loss selling or something, I don't know that there's going to be a better time going into the year-end. Well, that takes us to our first break. When we come back, we'll finish up on some of the markets as well as get into Roth conversions. So for All Things Money, my name is David Blain, and we'll be right back.